Hi guys, again today we are going to continue our work on inventory but move on to chapter 8 of the textbook and focus on purchase returns and sales returns, which is what chapter 8 covers. This video will really focus on what we mean by a purchase return. So what will you get out of this video and this lesson? The learning intentions are that you can define purchase return. We can record a purchase return in an inventory card, which hopefully you're getting pretty comfortable at now because that was a focus of chapter 7. We can do a general journal for a purchase return, and hence if we're doing a journal, we can post that to our ledgers. Afterwards, after having a great understanding of the purchase return, you should be able to identify the effect of a purchase return on the accounting equation. So if you had a really successful lesson and a successful little unit of work, which this video will comprise as part of, you will have recorded purchase returns in inventory cards using both identified cost and FIFO methods, which is a little bit different for purchase returns. And you've recorded purchase returns in journals and ledgers. So what do we mean when we talk about purchase returns? We are talking about what we call return of inventory. A trading firm, so any business that we might be an accountant for in this course, purchases goods on credit and also sells goods on credit. And you remember goods are inventory. So they buy inventory on credit, so they have to pay someone back, being an accounts payable. And they also sell goods on credit, sell inventory at a markup to make revenue, and that might be on credit because that's a way to make sales, and hence we have an asset called accounts receivable. In both occasions, sometimes the goods that we either receive or the goods that we sell are what are unsatisfactory for some reason and are returned to the business that sold them, hence the supplier. And you might think about, why would something be returned? I'm sure you've returned something that you've bought to a department store or whatever lots of times. What are some of the reasons why you might return it? They could be damaged or faulty. It could be the wrong size, so you've ordered size large t-shirts to sell in your business and they've given you mediums. They could have given you the wrong brand. It could be the wrong style or color that you ordered. Or it could just be actually delivered the perfect good, but it's delivered late and you no longer require it. Anytime that happens, there is a source document. And that source document is a new one, and we call it a credit note. The credit note is the source document used to acknowledge the return of goods. And as we just said, this might occur as a business if we are unhappy and we are returning it to a supplier, or when we sell a good to a customer. So, even though this video focused purely on purchase returns, there are really two types of returns. Purchase returns, the one we're going to focus on in this video, is when inventory is returned by our business to a supplier. When we have a supplier, we are talking about an accounts payable. You might see the term creditor as well. But there is also a sales return, which is the next video in this series. This is when inventory is returned to our business by a customer. So we've sold something that a customer is not happy with, and that customer, if it's a credit customer, is an accounts receivable. What does this credit note look like? It looks something like this. And this becomes quite difficult. And you might have a question. Is this a purchase or a sales return? What do we do when we see a source document? We become detectives and we start to look at it. This one, you'll see there has been 4, and you can see that there, 4 LED light touch lamps returned. Why were they returned? They were returned because they were damaged in transit. What we don't know, and we know the amount that they were, and you can see that it was $42.50, so $170 each, but it's a little bit hard to know, is it a purchase return or a sales return? we become that detective again. The credit note will identify the selling business at the top of the document. Who is the business at the top of this document? Wholesale trading. And the seller is always the business receiving the stock as a return. So wholesale trading is the business that is receiving the goods back. If we are wholesale trading, we can assume that we have a sales return because Elsternwick Electricals has paid us, has returned these touch lamps back to us. However, if we are Elsternwick Electricals, this would be a purchase return because we've returned it to the supplier. So you've got to be a bit of a detective. This will become a little bit more comfortable as you see some more examples. And you'll probably see a credit note in your exam. So let's do a purchase return. The purchase return, as we know, is returning goods by our business to its supplier. So it's all about accounts payable. And we've got an example. The business, us, has purchased 5 units of something for $100 plus GST on the 1st of June. How do we know it's a credit transaction? Because it says invoice. So we know that we have bought some inventory from a supplier on the 1st of June on credit. So we have a liability called accounts payable. We would record this in our general journal. Inventory has gone up because we have bought inventory. Inventory is an asset. Assets going up is a debit. We have also paid GST. We have paid $10 of GST for each unit because $100 plus GST, 100 times 10% equals $10. 5 units, 5 times 50, $50. If we pay GST, that means we are reducing how much we owe to the government because the amount that we owe to the government, which is the liability, is how much we receive minus how much we pay. Liability going down is a debit. If we have debits, we have to have a credit somewhere. What is that credit? Accounts payable. We owe to our supplier $550 because we pay them the $100 plus the GST for all five units. And we have some sort of narration at the bottom that tells us a story with a source document. But on the 2nd of June, the next day, we, our business, have opened the box and found that one of the units was damaged on transit, for example. So we are not going to accept that. We are not going to pay it. You don't pay for something that's damaged. So we're going to return that unit to our supplier, like anyone would, but we have to remove any trace of that unit from our accounting records. We just recorded in our general journal the day before that we got 5 units of inventory. What have we actually got? 4. How do we fix this up? We remove any trace in our accounting records of that one item. How do we do that? We reverse our debits and credits. And you might see that the debits and credits here are the opposite of the 1st June transaction. We are going to reverse our accounts payable liability. Accounts payable is a liability. Liabilities going down is a debit because we are obviously not going to pay them as much as we originally were going to. We are going to send some inventory back. We are going to have 1 less unit in inventory for us to sell. So our inventory will go down, and our inventory is going down is a credit because inventory is an asset. And our GST is reversed as well to balance it out. We actually owe a little bit more to the government because we are going to reverse that $10 of GST. If we think about our actual transaction, we returned to our supplier 1 unit at a cost price of $100, and we might use a credit note. We don't write it, but the supplier will. And our general journal here will look something like this. All I've done is put the appropriate numbers in. $100 of inventory is going back to the supplier. We owe $110 less to our supplier, and we owe $10 more of GST. We, of course, have to record these in our general ledgers. This might be quite a complicated slide, so you might want to pause it afterwards and have a look at it. If we think about our inventory on the 1st of June, we recorded that we got $500 of inventory, 5 units times 100, hence the debit. And if you look back at our inventory on 2 slides ago, and I can do that for you, $500 of inventory is a debit, and our opposite side of that transaction, our credit, is accounts payable. So you expect to see a debit here of $500. But on the 2nd of June, our inventory goes down by 100 because of a $100 credit. So our $100 credit there, right-hand side of our inventory. GST clearing does the same process, and so too does our accounts payable. And you might want to have a look at this to really understand these posting of our ledgers. And you can see I put that, just to reiterate, the purchase of goods is on the left of inventory and the return of goods is on the right of the inventory. And you can see what's basically happened is all that now has been worked out is if you do the debits and credits, we've basically now got 4 units of inventory in our business, which is exactly what happened. We also have to record purchase returns in our inventory card, because as you know, we record our ins and out of inventory in our inventory card. When inventory is returned to a supplier, the supplier issues a credit note and confirms the credit granted. And in the exam situation, it's really important to understand the cost price of the purchase return will be told to you. And we will almost certainly mirror that in SACS. So if you're looking for the cost price, it will tell you. So it will tell you which one to remove. It might not be as clear as just the cost price is $100 or $50 in this case, maybe, but it might tell you the one that is returned is from a purchase on the 2nd of May, for example. So for example, if we look at this inventory card, you can see that there are been transactions in on the 2nd of May and a transaction out on the 3rd of May. We know that the one that was returned on the 5th of May was from the purchase on the 2nd of May. That means that we know the one that we are going to return, the one that is going to go out of our business, must be one of the $12 units here. Hence, out goes one of the $12. Our balance means we now have gone from 7 of these units at $12 to 6. So when you're recording an inventory card, a purchase return will always result in something being in the out column. You'll be told the cost price somehow. It might be really clear, or you might have to do a bit of investigation and think it through, just like this question here. But always purchase return means we have less inventory in our business because we're returning it. That means inventory in the out column is impacted. Just a reminder, just to reiterate what I just said, how to record in this inventory card. It is recording the out column. First in, first out, or first in, first out, does not apply because it's recorded at the cost price specified by the supplier. If we final slide before we just have a quick review of our learning intentions and success criteria. What is the impact on our accounting equation because of a purchase return? Our assets are going to decrease because we have less inventory in our building. Less inventory because we've returned some of it. That decrease is as a result because our liabilities decreasing. Our accounts payable goes down and our GST goes up, but the decrease is the same as our assets because our owner's equity is not impacted, and we know our assets must equal our liabilities plus owner's equity. It makes sense that our business is not worth more or less in this because we're just returning something and fixing up a mistake. Guys, that's a lot. I'm just going to go all the way back to our learning intentions very quickly. Hopefully from this video, you can tick off the learning intentions. You can define a purchase return. You can record a purchase return in the inventory card, the general journal, and the general ledger. And you can identify the effect of a purchase return on the accounting equation. By doing textbook questions on all of those components, the inventory cards, the general journal, and the general ledger, you'll become an expert and be able to tick off those success criteria. Hope you enjoyed this lesson. I will post another one really soon on sales returns.